Hello there. Welcome back to my channel. In this video, we want to look at a question on interpretation of financial information. Our question is got 22 marks. It requires you to spend on average 20 minutes on the question. So our question is on Marchet Limited. So it reads, you are provided with information for Marchet Limited. The company is registered with authorized share capital of 2 million shares. 60% of these shares were already issued. I read the CEO, Nick Page, currently owns 40% of the issued shares, and the directors of the company decided to issue 50% of the unissued shares in July 2022. Calculate the minimum number of shares that Nick must purchase the majority as shareholder. So obviously, we need to work within the figures that we are given here. So initial capital in issue. So basically, by so doing, we can now be able to find the shares that are in issue. So we're going to say 60%, which is set at the authorized share capital, which is 2 million. So if you calculate it like that, you see that the figure that you are supposed to get there representing the shares that are in issue. We are just going to say 60%, which is 0.6, and then you multiply by your 2 million. So you get 1,200,000. So it means the shares that are in issue are 1,200,000. Then out of this 1,200,000, we are further told that Nick Page currently owns 40% of issued shares. So we are going to say 40% of 1,200,000 is the share that Nick Page owns. So if you go to other section, we can start by entering our 40%, which is obviously 40% of 1 million. That is 480,000. So this is the share that Page owns. And further information given, we are told that the directors of the company decided to issue 50% of the unissued shares. So obviously now we are saying the unissued shares. Now we are going to say, if you try to calculate unissued shares, we are told that 1,200,000 are issued out of authorized, which is 2 million. So we are going to say 2 million minus 1,200,000. So 2 million minus 1,200,000. So we know that if you calculate there, the answer that you're going to get is 800,000. So the shares that need to be issued, the shares that needs to be issued are 50% of the unissued shares. So obviously, 50% of the unissued shares, we are going to say now 800,000 represents unissued. So 50% of 800,000, 50% of 800,000 is a further issue that needs to take place. If you calculate, they are going to get it as 400,000. So 400,000 more shares are going to be issued. So the new level of issue would be 1,200,000 that are already issued, plus the further 400 that need to be issued. So it becomes 1,200,000 plus 400,000. So it means the shares in issue will be now 1,600,000. So from there, we can now be able to calculate what is required. So 3.1.1 reads, calculate the minimum number of shares that Nick must purchase in July 2022 to become the majority shareholders. So for Nick Page to become the majority shareholder, Nick Page should own at least half of the shares that are in issue, which is 1,600,000. So basically, on our answer section, we are going to find the difference between half of the shares that are in issue. So if you say 1,600,000, we divide 1,600,000 by 2, you will see that half of 1,600,000. So we have at least half of the shares that are in issue. If shares that are in issue are 1 million, you see that 800,000 becomes the half. So to find the number that Nick needs to acquire, it means we are going to say Nick needs to acquire at least 800,000. So we want to see at the level that Nick owns at the moment. So if you come here, So if you come at 3.1, it means that the CEO, Nick Page, currently owns 40% of the issued shares. So remember, 40% of the issued shares is the issued shares are 60% uh, of 2 million. And we calculated 60% of 2 million and we got 1,200,000. So 40% of these shares are the ones that Nick owns at the moment. So you're going to say on the section 40% of 1,200,000. So if you come here now, we are saying Nick's share 40%, 40% of 1,200,000 and got it as 480,000. He had 8 number of shares that needs to be owned. And remember, we have calculated here and we found that Nick has to own at least 800,000. So out of 800,000, Nick already owns the figure that we calculated here, which is 480,000. So we need now the difference between what is supposed to be the level of shares to be the majority, shareholder, and the current level of shares of Nick. So we say 800,000. And then from 800,000, then we subtract 480,000. And obviously, if you subtract there, so 320,000 is the minimum that is supposed to be issued to Nick, so that Nick becomes the majority shareholder. So if you come here, remember the requirements of our question. It's saying calculate the minimum number of shares that Nick must purchase in July 2022 to become the majority shareholder. So basically, we are saying, according to our calculations, now we are saying Nick should own shares that are greater than 320,000. But if Nick acquires 320,000, it will be 50%. So to become the majority, it means it has to be greater than 50%. So we're going to just add one share. So we're going to say 320,000. 320,000, and then we add one. So it means if you add one, you're going to get 320,000 and one. So these are the shares which needs which are needed by Nick to become the majority shareholder. So basically, this is the calculation that we have for the 3 marks. So going to our next question, you see that our next question now reads: Nick wants to purchase the additional shares of at 6 rand per share without advertising the shares to the public. Give 2 reasons why you would not approve this arrangement. Remember, shares has to be advertised. So this is an ethical behavior that needs to be undertaken by Nick, since the shares has to be advertised. So we are saying it is unethical as the shares would not be advertised. So this is the explanation that we are just going to give in our answer section. So remember, the question is saying give 2, that it is unethical, would not be advertised. Then moving on to the next point that we can put is that basically it's not allowed by the law, as the shares should be advertised through the prospectus. So we're saying not allowed. Not allowed by the law. And what is allowed by the law is that the shares should be advertised through the prospectus. So basically, those are the 2 points that we have. Then moving on to the next question. 3.2 reads, the directors are proposing that the business operations be expanded in the new financial year. One of the directors suggested that they finance the expansions by taking a loan of 1 million rands instead of issuing new shares to the public. Cotton explained 2 financial indicators to support this opinion. So there is an increase of loan, and increase of loan represents an increase in debt. So according to information given to the question, remember we have got a continuation in terms of the information that we are given in the question. So we are going to use this table to find for any financial indicator that is there that can support the increase in loan, which is increase in debt. So if you come here, we've got the debt equity ratio, and we are seeing that the debt equity ratio is increased from 0.34:1 to 0.9. Even if it increased, we are seeing that the proportion is still low, still still less than 0.5. So even if the proportion of debt increases, it's not going to be too high. So basically, we can explain it from that point that the debt to equity ratio is increased from 0.34 is to 1 to 0.44 is to 1. So the company still has a low financial risk. So if you look at the level of 0.44 is to 1, it indicates a low financial risk. So you come here, we try to raise that point by saying debt to equity ratio is increased to 1 to 0.18, indicating a low financial risk. So the question is two points. So if you go again to the information given, you see that we can check the return on used to see if we can increase the debt or increase the loan. We see that return on capital employed has increased from 18% to 26%. But if you look at 26% is return on average capital employed, it's more than the interest rate, which is 13%. 26% being more than 13%. So in that case, we see that the business is positively geared. So if it's positively geared, it's going to be beneficial by increasing the debt. So basically, we are saying on the second quote, the company is positively geared. The company is positively geared. Is we can just try to check in terms of the levels of return on capital employed as compared to the interest rate. We are seeing that the return on capital employed, which is the ROS, is 26%. Is 26%, which is more than interest rate of the interest rate is 13%. So basically, that's the second point that you can try to put down. Then go to the next question that we have. We are seeing that Bongani is a shareholder in Machete Limited. He owns 32,000 shares, which he purchased 2 years ago at 4.75 each. Calculate the amount of dividends Bongani would earn for the financial year ending 31 October 2022. So obviously, dividends, we are going to say number of shares times the value per share. So if you go to our financial indicators, we are going to see that the dividends per share is 110 cents in the current period. So if you say 110 cents, you divide 110 cents. So this is the one that we're going to calculate with. You say 110 cents times the number of shares, 32,000. So we come here now, multiply by 32,000 shares. And then the answer that you're supposed to get, you try to calculate that. The answer that you're supposed to get is 35,200. So basically, this is what we have. Then go to the next one. Should Bongani be satisfied with the dividend policy of Machete Limited? Quote and explain relevant financial indicators to support your answer. So to be satisfied with the dividends policy, you should check in terms of the proportion of dividends, or we can say the proportion of our earnings that that is being paid as dividends. So proportion of earnings being paid as a dividend. So we are going to say it's per share. So basically, this we are going to calculate it. So in terms of our presentation, we go to the information given. We're going to, and then earnings per share 130. So we're going to say 130 by 100 over 1. Present it as a proportion in percentage. We're going to get 84.6%, which is desirable. And we are seeing that a greater proportion of the earnings is being paid as a dividend. So obviously, the shareholders are going to be satisfied. So on our answer section, we are going to say the question is saying. So on our explanation now, we are going to say dividends per share. Dividends per share is 110 cents, and earnings per share is 130 cents, making 84 4.6% over 130 times 100 over 1, making 84.6% of earnings given to shareholders. Basically, that's what we have on 3.3.2. Then moving on to the next question, which is now saying Bongani wants to sell his shares in Machete Limited and invest his funds in alternative investments. You disagree with him? Quote and explain one relevant financial indicator other than dividends to discourage him from selling his shares. So obviously, the issue of the owning of shares is an indication of investment. So we have to compare with percentage of alternative investment, which is indicated by interest on fixed deposit, which is indicates the percentage of investing in alternative investment. So from there, we can compare the return on shareholders' equity, which is 24.1%, and we compare it with interest on fixed deposit, which is 6.5%. So if you look there, you'll see that the return on shareholders, on average shareholders' equity is greater than the interest on fixed deposits, which indicates that the return on the shares is more than the return that is earned in alternative investment. So that's why the question is saying you disagree with him. So you should explain by one financial indicator other than dividends to discourage him from selling his shares. So the financial indicator that we are going to refer to is the return on average shareholders' equity, which is 24.1%, being more than the interest on fixed deposit. So we come here. So we say return on shareholders' equity improved from 15% to 24.1%. 15% to which is greater than the return on alternative investment. Which is in brackets, we can just put 6.5%. So this indicates that strong performance of the company indicated by the return on shareholders' equity may continue in the future to offer greater returns. So that's why we are giving that advice. So basically, that's what we have. And this becomes the last question that we have according to our question 3. So thank you for listening. And please, let's not forget to subscribe and share to our channel. Let's meet again in the next video. As for this video, I'm signing out.